So if you break your arm, an X-ray gives you this purely binary answer.
Yeah.
Right? You hold up the film, you look at the bone, and it is either broken or it is completely fine.
Exactly, yeah.
Yeah.
Definitive.
Right. There is this jagged white line or there is solid bone. It's clean. And, it is, in a very real sense, incredibly comforting. We humans desperately like things to be visible and categorized neatly.
Oh, absolutely. Without any lingering ambiguity.
Yeah, exactly. But the moment you step out of the hospital and, step into the world of statutory financial reporting, that reliable X-ray machine just completely shatters.
It really does. We are no longer dealing with binary visual evidence at that point.
Right. We are looking at a linguistic and diagnostic landscape that is exceptionally murky. I mean, in this world, a single word placed slightly out of context in a 50-page document can completely obscure the true financial health of a massive corporation.
It's the absolute definition of diagnostic muddy waters, honestly. When you are reading financial statements, you aren't just looking at numbers on a spreadsheet,
Right. You're reading an entire language.
Exactly. You are reading a highly structured, legally binding language. And if the syntax of that language is flawed, the entire foundation of the company's reported reality just begins to crack.
Yeah. And you can have a sentence that sailed smoothly past the drafting committee, right? Past the internal reviewers, past the board of directors.
Oh, and even past the external auditors. All because it sounded familiar.
Exactly. Yet when it gets subjected to the strict, uncompromising light of the actual accounting standards, that familiar sentence completely unravels.
It falls apart instantly.
Which brings us to the core mystery we are unpacking today. So welcome to a brand new deep dive on the Gap Advisors in a Clinic podcast.
It is great to be here for this one.
Yeah, and if you are joining us, you likely know the stakes of this game, Whether you are an auditor staring down a deadline, a CFO signing off on disclosures, or maybe a CA student trying to wrap your head around the sheer volume of compliance rules.
The rules are immense.
They really are. So our mission today is to explore one of these hidden linguistic and technical traps, and we have our hands on a real-world example.
A very surprising real-world example, I might add.
Definitely. It is a single sentence pulled from the published financial statements of an actual listed company. A sentence that, honestly, most professionals would read right past without a second thought.
Oh, absolutely. They just skim right over it.
Right. But somehow, this one sentence manages to violate multiple Indian accounting standards simultaneously.
But before we put this specific sentence under the microscope, we really have to establish the physical boundaries of the arena we are operating in.
Yeah, that's crucial. Setting the ground rules.
Right, because accounting standards are ruthless about time and money. They do not allow for, abstract interpretations of when something happened or what currency it happened in.
No gray areas allowed.
Exactly. So, to ground our entire analysis today, we need to set two baseline parameters. First, through this deep dive, whenever we mention the reporting period, we are strictly defining that as the temporal window beginning on the 1st of April and ending on the 31st of March.
Okay, so we are anchored completely to the standard Indian financial year. So, if an expense is incurred at 11:59 p.m. on March 31st, it lives in a completely different universe than an expense incurred 2 minutes later on April 1st.
Precisely. The cutoff is absolute. There's no bleeding over.
Right. And the second parameter.
Second, we must establish the monetary context. So for the entity we are analyzing, both the functional currency and the presentation currency are strictly the Indian rupee.
Okay, so INR all the way.
Yes, and this is a vital baseline because the concept of functional currency drives how every single transaction is measured, right?
Because anything else throws a wrench in the works.
Exactly. By definition, within this specific framework, any currency that is not the Indian rupee is automatically classified as a foreign currency.
So whether it is the US dollar, the euro, or, the yen, if it isn't the INR, it triggers an entirely different set of complex translation rules.
Exactly right. If we don't hold these boundaries in our minds, April to March, and the Indian rupee, we just lose the precision required to actually enforce the standard.
Time and money, right, the fundamental coordinates. So now that we have our map, let's talk about the source material that actually led us to this specific compliance trap.
Yeah, this is where it gets really interesting.
Because the insights we are diving into aren't, theoretical musings from an ivory tower. They are drawn directly from a brilliant observation featured in the 221st edition of the Gap Advisors Task Weekly newsletter.
The consistency and depth of that newsletter are genuinely remarkable.
It's an absolute goldmine. I mean, for those listening who might not be familiar, this newsletter is authored by C.A. Manish C. Iyer, the director at Gap Advisors.
And it is published directly on LinkedIn, which makes it super accessible.
Right, exactly. There have been over 230 editions published to date. So if you are on LinkedIn and you are serious about understanding the granular reality of NIS, you really need to subscribe to it.
I completely agree. It is a fantastic resource.
It is completely free, and it consistently delivers these sharp, real-world aha moments about financial reporting.
Yeah.
It basically takes the abstract rules and shows you exactly how they are breaking down in the real world.
And speaking of the real world, I do need to provide a clear, vital disclaimer to you, our listener, before we go any further into the weeds here.
Ah, yes, the mandatory legal housekeeping. Go ahead.
Right. The views and interpretations expressed in this deep dive are the personal views of the author. They are not legally binding on you or any audience member.
Important distinction to make.
Absolutely. We are dissecting the logic of these standards, but we highly request that you seek the help of a qualified expert before taking any action or refraining from any action based on the views discussed here today.
Right, because financial reporting is intensely context-dependent, isn't it?
Exactly. Your specific facts and circumstances always require dedicated professional scrutiny.
Makes total sense. So use this deep dive to sharpen your thinking, but always bring in your own experts for the final sign-off. All right, let's get into the main event.
Let's do it.
We are going to look at this specific real-world accounting policy. And honestly, the craziest part about this is how it was discovered. It wasn't handed over by a whistleblower or anything.
No, not at all. It wasn't found during a hostile regulatory audit either.
Right, the origin of this observation is what makes it so compelling.
Yeah.
This was pulled directly from the published Ind AS financial statements of a listed company.
Exactly. These documents were already finalized, signed, and released into the public domain for investors and regulators to rely on.
Which is terrifying, honestly. The experts at Gap Advisors just downloaded these statements and independently reviewed them on a suo moto basis.
Right, meaning entirely on their own initiative, unprompted.
Nobody hired them to find a mistake. They were just running an independent, objective review of what companies are actually putting out there in the world.
And buried right there in the section detailing research and development expenditure, they found this single sentence.
Yeah, I have the exact verbatim policy right here. Listen closely to how this listed company described their R&D accounting to the public. Expenditure of capital nature are capitalized, and expenses of revenue nature are charged to the statement of profit and loss as and when incurred.
That is the complete, unedited policy they disclosed. That is their entire stance on how they handle the costs of researching and developing new assets.
Wait, hold on. I need to pause right here. Because to the untrained eye, or honestly even to someone who has taken like a few basic accounting courses, that sentence sounds perfectly logical.
It does. It sounds like foundational accounting 101.
Right. It's like sorting a massive pile of laundry. The heavy, expensive winter coats, those are your items of capital nature. You don't throw them in the daily wash.
No, you definitely don't.
You hang them up in the closet, you preserve them, you capitalize them because they are going to provide value over multiple winters. But your daily t-shirts, your basic socks, those are your items of revenue nature.
Right, they get used up immediately.
Exactly. So they go straight into the washing machine, or in accounting terms, they get charged directly to the statement of profit and loss as soon as you incur the cost. It makes intuitive sense.
It really does sound perfectly reasonable when you put it like that.
Heavy things get capitalized, daily things get expensed. So why is Gap Advisors ringing massive alarm bells over a sentence that feels so structurally harmless?
Well, the laundry analogy actually highlights the core danger of this sentence. Sorting laundry by heavy coats and daily t-shirts works fine if you are managing a household closet.
Right, because it relies on a very casual visual assessment.
Exactly. But if you are running a highly regulated, publicly traded company trying to internally generate complex intangible assets like proprietary software, chemical patents, or specialized manufacturing processes, it's a different story entirely.
Yeah, I imagine you can't just eyeball a software patent.
You really can't. So simply saying, we sort the capital stuff from the revenue stuff is catastrophically inadequate. In the strict context of statutory financial reporting under Ind AS, that seemingly innocent sentence fails on two entirely separate, massive fronts.
Wow, two distinct failures in a single sentence. Let's break them down. Where does the logic first collapse?
The first failure is a severe structural violation of Ind AS 38. That is the standard that specifically governs intangible assets.
Okay, Ind AS 38, what does it say?
Well, the company's policy completely ignores the mandatory step-by-step classification requirements laid out by the standard setters. To understand the gravity of this, we really have to look closely at the text of paragraph 52 of Ind AS 38.
Okay, so if I'm a company spending millions of rupees on research and development, hoping to create a new patent or a new software platform, I can't just look at my invoices and arbitrarily decide what feels like a capital coat and what feels like a revenue t-shirt.
Absolutely not. Paragraph 52 steps in and dictates a very rigorous process.
What exactly does it demand?
Paragraph 52 dictates how an entity must assess whether an internally generated intangible asset actually meets the strict criteria for recognition on the balance sheet. And the rule is absolute.
Absolute in what way?
It mandates that the entity must classify the generation of the asset into two distinct chronological and conceptual phases. Phase A is the research phase, and Phase B is the development phase.
Okay, so you have to split it up.
Yes, you cannot bypass this mapping process. It's mandatory.
And this isn't just a suggestion to be organized, right? The standard is forcing you to map the timeline of your expenditure.
Yeah,
But why the heavy emphasis on the specific word phase?
that's a great question.
Like, why couldn't the company just say research costs and development costs?
Because the standard setters knew that companies would try to play fast and loose with colloquial definitions. And AS38 explicitly unpacks this wording.
How so?
It states that although the words research and development might be broadly defined in a regular dictionary or in general business parlance, the specific terms research phase and development phase have a much broader, highly rigid regulatory meaning for the purpose of this standard.
So it's a mandatory classification framework. It's not just semantics.
Exactly. It's a structural requirement.
Let me try to trace the underlying mechanism here, the why behind the rule. If standard setters didn't enforce this strict phase approach, a company could just look at a massive invoice for, say, specialized lab equipment or a team of highly paid data scientists, right?
And the CFO might look at that and say, well, these scientists are brilliant and this equipment will last 5 years, so this is clearly of a capital nature, put it on the balance sheet.
Exactly. But by forcing the company to define the phase of the project, the standard setters are basically short-circuiting that logic. They're saying the nature of the invoice doesn't matter nearly as much as the timing and certainty of the project itself.
That is the exact psychological and economic mechanism at play here. The standard setters deeply understand the inherent risk of internally generating an intangible asset.
Because it's basically a gamble until it's finished, right?
Precisely. Let's look at the historical context for a second. Think back to the major accounting scandals of the late 90s and early 2000s.
Oh yeah, the really messy ones.
Right. Companies were aggressively capitalizing operating expenses to make their current year profits look phenomenal. They were creating what we call phantom assets on their balance sheets.
Phantom assets? That sounds terrible.
It is. These were assets that had no real economic value, but they served to hide the massive cash the companies were burning through. In AS38 was designed specifically to prevent the creation of those phantom intangible assets.
Okay, so the research phase is essentially the danger zone for phantom assets.
Exactly. In the early stages, the research phase, you are just exploring. You are gathering new knowledge, testing wild hypotheses, trying to find a new chemical compound, or testing out a theoretical software algorithm.
You're throwing stuff at the wall to see what sticks.
Yes, and the standard setters determine that because the outcome in the research phase is so wildly uncertain, you cannot capitalize a single rupee of it.
Not a single rupee.
Not one. It is entirely irrelevant if the expenditure feels like a capital cost. You haven't proven economic viability. Therefore, all expenditure in the research phase must be expensed immediately to the profit and loss statement.
Wow. But once you cross over into the development phase, the rules of gravity change.
They do, but only under very strict conditions. The development phase occurs further down the conceptual timeline.
Like when you actually have a blueprint.
Right. It is the point where you take those successful research findings and start actively applying them to a specific plan or design for a new product right before you start commercial production.
Okay, that makes sense.
In the development phase, you might actually be able to definitively prove that this product is technically feasible, that you have the intention and the resources to finish it, and crucially, that it is highly probable it will generate future economic benefits.
And only then can you start putting it on the balance sheet.
Exactly. Only then can you begin capitalizing those costs. So the phase approach is the fundamental gatekeeper.
It's the only mechanism that determines whether millions of rupees hit your P&L today, which obviously tanks your current profits, or sit comfortably on your balance sheet as an asset for tomorrow.
You hit the nail on the head.
And when we bring that massive, crucial context back to our listed company's one-sentence policy, expenditure of capital nature are capitalized and expenses of revenue nature are charged to the statement of profit and loss, the silence is deafening.
It really is. They completely omitted any mention of the research phase or the development phase.
They completely bypassed the mandatory gatekeeper. They just relied entirely on the broad, legally undefined legacy terms of capital nature and revenue nature.
Right. And by doing so, they failed to provide the reader of the financial statements with the specific roadmap that Ind AS 38 demands.
It's like they told the investors, trust us, we sort the laundry into heavy coats and light t-shirts, without ever disclosing whether the clothes were actually manufactured in the highly speculative research lab or the commercially viable development lab.
That's a perfect way to put it. Because the group has not stated whether it classifies its expenditure into these two required phases, the accounting policy on research and development is entirely out of accordance with Ind AS 38.
They just straight up failed the structural test.
It is a fundamental lack of required disclosure. The reader has no assurance that the company is properly evaluating the technical feasibility or economic viability of their projects before capitalizing costs.
But, this raises a really thorny practical question. If you're an auditor listening to this, you've probably stared at a messy R&D ledger at 2 a.m. on a Tuesday, wondering what on earth to do.
Oh, without a doubt. It happens all the time.
Let's say you are auditing a massive biotech firm or an AI software developer. Innovation in those fields isn't a neat, linear assembly line, right?
No, it's incredibly chaotic.
Exactly. The line between we are just messing around with data models and we are now developing a commercial AI product is incredibly blurred. So what happens in the real world when the project is so messy that you simply cannot tell where the research phase ends and the development phase begins?
That is one of the most common and high-stress dilemmas in modern auditing. Standard setters fully anticipated the messy reality of corporate innovation, which brings us to the crucial safety valve.
Okay, what's a safety valve?
Paragraph 53 of Ind AS 38. This is the ultimate fallback protocol.
The fallback protocol. If the timeline is a mess, what does paragraph 53 force the company to do?
The standard is mercilessly clear on this. Paragraph 53 states, if an entity cannot distinguish the research phase from the development phase of an internal project to create an intangible asset, the entity treats the expenditure on that project as if it were incurred in the research phase only.
Oh, wow. That is a brutal rule for a company trying to protect its profit margin.
It really is. It's highly conservative.
It's like a sports referee relying on video playback. If a wide receiver catches a pass in the end zone, but the camera angle is blurry, the referee has to look for indisputable visual evidence that both feet stayed in bounds.
Right, and if they can't see it.
If the evidence is messy, if it's indistinguishable, the referee cannot award the touchdown. The burden of proof is entirely on the offense. They must default to the safest, most conservative ruling, incomplete pass.
That referee analogy is absolutely perfect because it highlights the concept of the burden of proof, and AS 38 operates on extreme prudence.
So capitalization is a privilege, not a right.
Exactly. Capitalization is a privilege. If you cannot definitively prove you have crossed the threshold into the development phase where capitalization becomes legally permissible, you must conservatively assume you are still wandering in the highly uncertain research phase.
Which means all of those costs, no matter how massive they are, hit the P&L immediately, right? Directly reducing the company's reported profit for that period.
Every single rupee, yes.
And this really exposes the secondary danger of the listed company's policy. By simply writing capital nature and revenue nature, they are hiding their methodology from the reader entirely.
Completely obscuring it.
Right. I mean, if a project at this company gets messy and indistinguishable, are they applying this strict paragraph 53 fallback rule and expensing it all? Or are they just arbitrarily deciding that certain invoices look like they are of a capital nature and throwing them on the balance sheet anyway?
The reader has absolutely no idea, and that is the critical compliance gap. Without the specific terminology of phases, the transparency of the entire R&D operation is compromised.
It really is. The financial statements just fail to provide the clarity and the rigorous assurance that the standard was explicitly designed to enforce.
Exactly. The investors are left completely in the dark about how aggressive or conservative the company's capitalization policies actually are.
It really makes you pause and think about the immense, crushing pressure the statutory auditors are under.
The pressure is astronomical.
I mean, if a single, seemingly standard sentence about R&D, a sentence that probably went through internal legal, the CFO's desk, and the audit committee, can trigger a fundamental Ind AS 38 violation, how does any professional survive in this landscape?
It's incredibly difficult.
How do finance teams and auditors keep track of these microscopic linguistic nuances and ensure they are rigorously documenting their application in the working papers? Because if the regulators come knocking, saying it looked fine to me, isn't exactly a valid defense.
It's not a defense at all. The sheer volume, complexity, and interconnectedness of the Ind AS requirements make it physically impossible to rely on human memory or legacy drafting practices.
You definitely can't just copy-paste last year's disclosures.
No, you cannot. This is exactly why the resource mentioned in our source material is so vital to the modern accounting profession.
Let's talk about that lifeline. The source text points to a highly practical, centralized solution for navigating this exact type of regulatory minefield, right? The JAP Advisors Issue Repository.
Yes. The repository available at gapadvisors.com is genuinely a monumental tool.
It sounds like it. How big is it?
Well, to give you a sense of the sheer scale of knowledge captured there, it currently hosts over 4,500 individual issues and their highly detailed expert responses regarding the application of Ind AS and Indian GAAP.
Wow. Let that sink in.
Yeah.
Over 4,500 highly specific, nuanced scenarios.
It's a massive database of applied knowledge.
That means thousands of complex borderline situations, just like the indistinguishable R&D phases we just discussed, have been meticulously analyzed, documented, and resolved by experts. It's like having a hive mind of the best technical accounting brains right at your fingertips.
And the accessibility of this database is really what transforms it from a theoretical archive into a daily practical tool.
How so? Can anyone use it?
Yes. Any person can register on the platform for completely free. And once you are registered, you aren't just limited to searching the past archive.
Oh, you can ask new questions.
Exactly. You can actually submit your own specific, live, complex issues on Ind AS and Indian GAAP.
So if I'm that auditor at 2 a.m., staring at a client's messy R&D policy, and the client is arguing aggressively that their generic capital nature phrasing is perfectly fine, I don't have to fight that battle armed only with my own interpretation.
No, you don't.
I can submit that exact wording as an issue.
Yes. You submit the specific scenario and you receive a detailed, custom expert response delivered directly to the inbox of the email you registered with at gapadvisors.com.
That is incredibly powerful for an auditor's workflow. Because, the job of an auditor isn't just to know the right answer internally.
Right. Knowing it is only half the battle.
Real job is building an impenetrable audit trail. They have to rigorously document how they arrived at their conclusion, especially when challenging a powerful client.
That is the absolute crux of the matter. This repository is extremely helpful, particularly for auditors who need to comprehensively document how they addressed any contentious issue regarding the application of Ind AS in their working papers.
Because the regulators are always watching.
Exactly. Regulatory bodies like the NFRA or the PCAOB demand meticulous documentation of audit judgments. Having a documented, independent, expert analysis of a complex standard directly from GAAP advisors provides an incredibly robust, defensible foundation for their audit conclusions.
It moves the conversation from the audit partner thinks this phrasing is risky to we have documented independent expert consensus that this terminology explicitly violates paragraph 52 of Ind AS 38.
Precisely. It removes the subjective friction completely.
To everyone listening, whether you are preparing the statements, auditing the statements, or studying to do either in the future, do yourself a massive favor. Get over to gapadvisors.com, register for free, and integrate that repository into your workflow. It is a vital shield against these hidden traps.
It really is an essential tool.
Now, I want to pivot back to our listed companies text because the trap we just dissected was only the first failure.
Oh, yes, the second failure.
The policy read, expenditure of capital nature are capitalized and expenses of revenue nature are charged to the statement of profit and loss. We have thoroughly dismantled why ignoring the word phases violates AS 38. But earlier, you teased a second, perhaps even more fascinating error hidden specifically in the phrase expenses of revenue nature.
I did, and it is a fascinating one.
You called it a semantic contradiction.
Yes, and this is where we transition from discussing structural accounting logic to examining strict, unyielding linguistic compliance.
Okay, linguistic compliance. Let's get into it.
To understand why the phrase expenses of revenue nature is a literal oxymoron, We really have to look at the overriding rules of terminology mandated by Schedule 3rd.
So if Schedule 3rd's entering the chat, we are talking about the master dictionary, right? What exact rule are we looking at?
We specifically need to look at Clause 8 of the General Instructions for the Preparation of Financial Statements.
And these aren't just polite suggestions, are they?
Not at all. These instructions are mandatory for any company required to comply with Ind AS under Division 2 and Division 3 of Schedule 3 to the Companies Act 2013. Clause 8 lays down a very strict linguistic law that governs every single word in the document.
What does the law state?
It states, "For the purpose of this schedule, the terms used herein shall have the same meanings assigned to them in Indian accounting standards."
Okay, let me reason this out. Schedule 3 is essentially dropping a legal hammer on the drafting process.
Oh, a very heavy hammer.
It is saying you cannot use a colloquial dictionary. You cannot use Wikipedia. You cannot even use what you learned in business school 20 years ago. You must use the exact isolated definitions provided within the Ind AS framework.
Precisely. It completely anchors the vocabulary of the financial statements to the specific definitions locked within the individual standards.
So the standards are the only permissible dictionary.
Exactly. So if a listed company chooses to use the term revenue in its accounting policy, we must look exclusively at how Ind AS defines the word revenue. We cannot rely on what the CFO thinks it means.
All right, let me look up that exact definition. If we are defining revenue, we have to go to Ind AS 115, which is revenue from contracts with customers.
Right. Let's look at Ind AS 115.
Looking at Appendix A of Ind AS 115, it defines revenue extremely specifically. It says revenue is income arising in the course of an entity's ordinary activities.
Hold that definition firmly in your mind. Income arising. Under the strict, legally binding dictionary of Ind AS, revenue explicitly equals income.
Wait a minute. If I substitute that definition back into the company's policy, oh wow, this is a massive aha moment.
I told you it was fascinating.
If the word revenue is legally and strictly defined as income, then what on earth is an expense of a revenue nature?
When you apply the mandated definition, the phrase expense of a revenue nature literally translates to an expense of an income nature.
That is just. It's a sheer logical impossibility, an expense of an income nature. It is an absolute, undeniable oxymoron.
It absolutely is.
It's like writing a weather report that warns of a freezing kind of heat, or describing a room with a dark kind of brightness.
Right.
It makes absolutely no sense.
It represents a fundamental collapse of logic under the strict definitions of the standards. None of the Indian accounting standards define a scenario where revenue could ever be regarded as an expenditure.
Because they're opposites.
Exactly. They are mutually exclusive, diametrically opposed concepts within the framework. You are either receiving economic benefits, which is income, or you are consuming economic benefits, which is an expense.
You cannot have an expense that is fundamentally of an income nature. It just breaks the brain.
It does. It violates the core logic of the entire system.
But this brings up a massive behavioral question. Why do highly educated, experienced professionals do this? Why would a listed company with layers of governance and expensive auditors write expense of a revenue nature?
It's a great question, and it really comes down to human nature.
I mean, I feel like I've heard the term revenue expenditure a million times. It's in textbooks, it's used in board meetings, it's thrown around in financial news all the time.
And that ubiquity is exactly the root of the problem. What is so fascinating here is the sheer gravitational pull of legacy.
Legacy habits are hard to break.
Very hard. Revenue expenditure is a deeply ingrained traditional accounting term. It was widely used and perfectly acceptable under older historical accounting frameworks and traditional Indian GAAP.
So it used to be right.
Exactly. For decades, it was the standard way to differentiate day-to-day operational P&L expenses from long-term capital investments. Entire generations of accountants and CFOs were trained using that exact vocabulary.
It's basically muscle memory for them. People are incredibly comfortable with it because it feels like real accounting language.
But comfort does not equal compliance.
Exactly. Just because a phrase feels authoritative doesn't mean it survives the transition to a new regulatory framework.
Precisely. The transition to Ind AS wasn't just a change in calculation methods, It was a fundamental rewiring of the accounting language itself.
So the old dictionary was thrown out.
Yes. Therefore, despite its historical popularity and its colloquial comfort, the use of the term revenue expenditure or revenue nature to describe an expense is entirely out of accordance with Ind AS 115 and Schedule 3 to the Companies Act, 2013.
So it's just illegal in this context.
Essentially, yes. Old habits, no matter how widespread or deeply ingrained in the corporate culture, do not override strict Ind AS definitions. When the regulatory law dictates that a word means income, you cannot legally use it to describe an expense in your statutory reporting.
The cognitive dissonance of the older generation cannot dictate the modern compliance reality.
Brilliantly said. It cannot.
This is a deeply sobering realization because it forces us to reflect on the origin of this whole discussion. This error wasn't caught on a whiteboard during a training seminar.
No, it was out in the wild.
Exactly. It wasn't found in a rough draft that was cleanly fixed before publication. This linguistic oxymoron was found suo motu in a published, finalized statement of a listed company. Investors are reading this right now.
And analysts are building models based on these exact disclosures.
Right. Having your published financial statements flagged for basic terminology and classification errors is something every single company desperately wants to avoid. The reputational cost is massive.
It really is a terrible look.
It signals to the market that the company might lack rigor in its financial reporting process. I mean, if they are making elementary copy-paste errors with oxymorons, what else are they missing in the complex valuation models?
The signaling risk is severe. The cost of public errors in statutory reporting goes far beyond just regulatory fines. It fundamentally erodes stakeholder trust.
Which is the most valuable asset a company has.
Absolutely. But the good news here is that this is an entirely preventable problem. There is a highly effective, actionable step that corporate finance teams can take to ensure these legacy traps never make it into the public domain.
Okay, let's talk about the preventative solution. How do companies actually catch these blind spots and oxymorons before the cement dries?
The most robust, foolproof safeguard is to get your financial statements comprehensively reviewed by GAAP advisors before signing them. This is what is known as a pre-signing review.
A pre-signing review. Let me explain the mechanics of this to our listeners, because the process is incredibly straightforward and highly efficient. A company doesn't need to install complex software or go through a massive onboarding process.
No, not at all. Be very simple.
They can simply submit their draft financial statements in a near-to-publishing PDF format via email directly to info@gapadvisors.com.
That pre-signing window is the absolute critical intervention point. It allows independent experts who look at these documents with a completely objective, standard-focused lens to catch these exact types of subtle legacy wording errors.
Because the internal team is just too close to it?
Exactly. When a finance team spends 3 months drafting a 50-page document, they become structurally blind to their own habits. They read what they intended to write, not what the strict Ind AS dictionary says they actually wrote.
An independent pre-signing review just cuts straight through that internal blindness.
It does. It's essential.
It's exactly like having a master editor review a manuscript before a book goes to print. But instead of checking for dangling modifiers or comma splices, these experts are checking for fatal Ind AS contradictions.
And finding them, clearly.
Right. So by sending that PDF to info@gapadvisors.com before the ink is dry on the board's signatures, a company ensures that errors like missing the mandatory phases of Ind AS 38 or creating illegal linguistic oxymorons against Ind AS 115 are identified and rectified before they are cemented in the public record.
It is an essential investment in the integrity, the precision, and the indisputable quality of the financial reporting process. It transforms a document from, we think this sounds right, to this is rigorously compliant.
Well, we have covered an immense amount of ground today, and we've drilled down into the microscopic details that actually hold the financial system together.
It's been a fantastic deep dive.
We started with the suo motu discovery of a supposedly innocent logical sentence. We deconstructed the strict mandatory phases of Ind AS 38 and explored why standard setters are utterly terrified of phantom assets.
And rightly so.
We examined the fallback safety of paragraph 53 and the heavy burden of proof it places on companies. We navigated the strict linguistic laws of Schedule 3, and finally, we exposed the ultimate impossibility of an expense of an income nature. It really highlights how deeply, fundamentally, language matters in the world of accounting.
It absolutely does. Accounting is not merely a collection of numbers and math. It is a highly structured, legally codified language, and the syntax of that language must be flawless if the numbers are to have any meaning at all.
As we wrap up this deep dive, I want to leave you, our listener, with a final provocative thought to mull over when you go back to your desk.
Let's hear it.
We just spent a significant amount of time proving how a term as common, as traditional, and as universally accepted as revenue expenditure can completely unravel a company's compliance across multiple accounting standards. It makes you wonder, what other traditional, comfortable accounting phrases are hiding in your company's policy documents right now?
That is a scary thought.
What other legacy phrases are quietly violating Ind AS definitions without anyone in the boardroom even noticing? Are you absolutely 100% sure your vocabulary is compliant?
That is the critical, uncomfortable question every preparer, every CFO, and every statutory auditor must ask themselves today.
It really is.
And if this deep dive has sparked that question in your mind, or if it made you rethink a policy you drafted last week, we have a vital request for you.
Yes, please do share this.
Please share this deep dive deeply within your professional network. Share it among your immediate contacts, forward it to your colleagues, send it to your entire audit and finance teams.
Spread the knowledge.
And crucially, share it with students who are currently pursuing the CA course. They are the future of the profession, and helping them bypass these legacy traps and spread the precise modern knowledge of Indian accounting standards is absolutely vital for the integrity of financial reporting in India.
I couldn't agree more. Knowledge is only powerful when it is shared and applied. Thank you so much for giving your time to this deep dive today. We know how incredibly demanding and valuable your time is in this profession, and we hope this granular exploration has provided you with a powerful shortcut to being deeply informed and highly vigilant in your work.
Thank you all for listening.
Finally, please ensure you follow or subscribe to the Gap Advisors Ind AS Clinic podcast on your platform of choice. Whether you prefer to listen and learn on Spotify, Amazon Music, or YouTube, we are there. Subscribing ensures you never miss out on these crucial, real-world insights that can save your compliance profile. Until next time, keep your language precise, keep your research and development business distinct, and always keep questioning the comfortable legacy phrases hiding in your financial statements.